All right, in this lesson, we're going to go through an example. We're going to look at journal entries and we are going to actually solve journal entries. So this was kind of the major concept that we learned in this section. So we want to make sure that you understand that as you move off of section 2. So let's take a look here. We've got some information about this example. The following are transactions associated with Polar Pop Inc. On June 1st, Polar Pop purchased a $12,000 piece of equipment and paid for it using $4,000 in cash, and the remainder will be due on account in 30 days. On June 8th, Polar Pop ordered supplies from their supplier that will be delivered in 2 weeks. On June 18th, Polar Pop issued a check for $8,000 to their equipment supplier as payment for their equipment on June 1st. And then on June 28th, Polar Pop received the supplies they ordered on June 8th. According to the invoice, the supplies are worth $5,000 to Polar Pop. They agreed to pay within 30 days of delivery. Prepare the journal entries for Polar Pop. So we've got 4 journal entries that we're going to look at here, and we're going to look at them individually. All right, so a couple of things as a reminder here. Right below me, you have the expanded equation. The expanded equation is like the key of how we do journal entries. And then up on the top, we've got steps 1 through 6. That's kind of the step process of actually doing a journal entry. We're not going to concentrate on that, although it's there for your convenience. We are going to do most of what those steps are, but we just won't call them steps. Then we've got the example, and then we've got our boxes below that help us organize what the journal entry is going to look like. And then we finally have the journal entry at the bottom. So let's get started here with June 1st. Polar Pop purchased $12,000 piece of equipment and paid for it using $4,000 in cash, and the remainder will be due on account in 30 days. So the first thing that we want to do is to figure out what accounts are being affected by this transaction. So what is happening? Polar Pop is receiving a piece of equipment, and what are they giving up? Well, they are giving up cash, and they're giving up an IOU or a promise to pay. So that kind of gives us our 3 accounts there. So they're getting equipment, so we know equipment's going to be affected. And then they're giving up at least cash, so cash is going to be affected. And then the last thing is so we're not paying $12,000 in cash, so we have this $8,000 hole. Where is that hole going to? Well, it's a promise to pay, and we said a promise to pay that is not a formal agreement is an accounts payable. We're going to account for the amount we're going to pay later on. So accounts payable. All right, so equipment, cash, and accounts payable. Now we got to decide which one of the 6 components, asset, liabilities, owner's equity, revenues, expenses, or dividends, are each one of these 3 accounts. So we'll start with equipment. Is it an asset, liabilities, owner's equity, expense, revenue, or dividend? Well, the equipment provides a long-term benefit to the organization. Therefore, it is an asset. What about cash? Well, cash is a benefit that will yield benefit to the organization, so that's an asset as well. And then accounts payable is a liability because we owe it to someone else. All right, so we have equipment as an asset, cash is an asset, accounts payable is a liability. Is it increasing or decreasing? Well, we're receiving equipment, so that means that our equipment balance is going to go up, so increasing. Cash is leaving our pocket, and because it's leaving our pocket, it's decreasing. And accounts payable, we now owe more because we owe more, liability is increasing. We owe more liability. All right, so we've got equipment, asset increasing, cash, asset decreasing, accounts payable, liability increasing. Now we can use the key to help us solve this problem. So equipment is an asset. The asset is increasing. We are going to debit equipment. What about cash? Cash is also an asset, but it's decreasing, which means we are going to credit. And then accounts payable is a liability. That liability is increasing. We are going to credit the accounts payable. So now that we have everything put together, it's time to do the journal entries. So we'll start with the debit. So debits always go before credit. So the debit here is going to be equipment for its full cost. Its full cost is $12,000. So even though we only paid 4, we still need to book 12 because that's what it's worth. That's what it costs us, not necessarily what it's worth. That's what it costs us is $12,000. All right, now that's all of our debits. Now we need to work on our credits. Our credit here, doesn't matter which one goes first. We're going to use cash first. So we'll credit cash in the amount of $4,000 because that's how much we paid. And then we are also going to credit accounts payable, and that a payable is going to be for the difference. So in this case, $8,000, because $4,000 minus 12 is $8,000. So that's our journal entry for this purchase of equipment, debit equipment, credit cash, credit accounts payable, $12,000, $4,000, and $8,000 respectively. All right, moving on to the second example here. Polar Pop ordered supplies from their supplier that will be delivered in 2 weeks. So what has exchanged? Nothing has exchanged. So if nothing has exchanged, then this is just a promise, okay? So a promise, we have no entry because there's nothing in exchange, okay? So a promise to pay is different, assuming that an exchange has occurred. So in the last example, there was an exchange. I got the equipment. That is the exchange. Even though I'm promising to pay later on, I still have an exchange, so we are going to book that. There's no exchange. There's just a promise that something's going to occur. So no journal entry there. Moving on to example 3. Polar Pop issued a check for $8,000 to their equipment supplier as payment for their equipment. So what did we give up? Well, we gave up cash. What did we get? A release in our obligation to owe that vendor. So we're getting a release of that obligation. What's that obligation? That accounts payable that we booked in that first example there. Okay, so what accounts are affected? Well, cash is going out, so cash. And we're going to decrease what? The payable, because that's how much we're being released of it. So accounts payable. So what component is cash? Cash is an asset. What about accounts payable? Accounts payable is a liability. What's happening in our cash? Well, if I'm paying it, it's decreasing. What about accounts payable? It's a liability. Because I'm paying it, I'm decreasing the amount that I'm owing this company or owing anybody for that matter. So I'm decreasing the debt, so decreasing. All right, cash, asset, decreasing. We're going to credit the cash. Accounts payable is a liability. That liability is decreasing. We are going to debit the accounts payable. All right, now we do have credit first and debit second, but we know that we always have to put debit first, then credit second. So we'll start with the debit. The debit here is accounts payable for $8,000, and then cash will be a credit for $8,000. So that is our journal entry there. All we're doing really is we're reversing that accounts payable. So we had a credit for the accounts payable. To get rid of it, we have to do the opposite. The opposite's a debit. That's what we did here. And then the cash is going out. Cash going out is a credit because cash going in is a debit. So the reverse of that would be a credit. So that is our journal entry for this $8,000 check. All right, last one here. Polar Pop received the supplies that they ordered on June 8th. So June 8th, we didn't make any journal entries at all because it was a promise, but now we received it. So an exchange has happened. According to the invoice, the supplies are worth $8,000 to Polar Pop. They agreed to pay within 30 days of delivery. So what do we know? They gave us the supplies. We gave them nothing. Okay, we gave them a promise to pay, right? We didn't give them cash, so we know that we're not going to pay it with cash, so we're not going to use cash, but what are we going to use? We are going to use an accounts payable. We are going to pay them when? In 30 days. So with that, what accounts are going to be used here? Well, we are going to use the supplies account because we're receiving supplies. And we're also going to use the accounts payable because we owe. Now, what components of supplies? Well, supplies provides us a future benefit for the organization. It's not an expense. It's an expense when we use the supplies, but we haven't used the supplies yet. So they're just, they can be sold. We could resell them if we wanted to get our money back, or we can return them. So we haven't used them. So because we haven't used them, it is an asset. The accounts payable is a liabilities. Supply, we're receiving supplies, so that's increasing our supply balance. The accounts payable, we now owe more, so that's increasing. All right, supplies is an asset. The asset is increasing. We are going to debit supplies. For accounts payable, that's a liability, so liability over here. We're seeing it increase, so we are going to credit the account. All right, debits go before credits, so supplies is going to go first in the amount of $8,000 because that's how much they're worth to Polar Pop. That's their cost. And then our credit is accounts payable because we haven't paid yet. We will pay in cash. So that establishes the liability right now. And then when we pay cash, we'll go ahead and reverse it later on. So that is our examples for journal entries. You've seen it quite a bit in this section, so hopefully now you have a better understanding of how to do it. I know this is just the start of it. If you're having trouble, I would go back to the sections that we did the examples 1 through 8 to get that going. If you're having trouble with just understanding the debits and credits, check out that lesson. If you're having trouble with the key, the expanded equation key, go back to the expanded equation and the debits and credits lesson and trying to understand, we need to know, is it asset, liabilities, owner's equity, revenues, expenses, or dividends, and then follow the side accordingly. I can tell you that the more practice you do on this, the easier the journal entries get. I promise you that. They get easier because you start practicing. So accounting is all about doing. It's not a passive activity. If you think this is a passive activity, it's not. Leave that for your management classes or your marketing classes. This is a math class at the end of the day. So you want to be doing it so that you get practicing. The more practice, the easier this becomes. So hope you enjoyed this example walkthrough, and we'll see you in the next lesson. Hey guys, it is Patrick. Don't forget to press the like button and share this video with someone who could get a lot of use from watching this lesson, like maybe a classmate or maybe a friend or maybe just a parent, just because you wanted to share this video because you're very excited about what you saw. Share it with someone. And if you want to help us grow and help us make sure that we put the very best in accounting topics out on YouTube, make sure you press the subscribe button and turn on that notification bell. That way you're alerted every time we post videos to this channel. Now, I do this with every one of my classes at the end of class. What did you learn from this lesson? Put that in the comment section below and I'll respond to you on what you got out of this video. So hope you enjoyed this video and we will see you in the next lesson.